In this session, I am going to look at this instrument, sovereign credit default swaps, which are typically the credit default swaps itself, which offer protection against any credit risk event to an investor. So, more similar to that of an insurance contract, but primarily associated with sovereign securities, sovereign credit. Instead of a corporate bond or a corporate credit, I'm looking at the underlying being the sovereign credit and some kind of protection that is being offered against this sovereign credit. So these are the instruments which have become popular because they even offer not only the protection against this sovereign default, the hedging part, but they also offer the opportunity with respect to speculation, and they also offer the opportunity with respect to arbitration. In another way, talking about the basis trading, right? Arbitrage, where we are talking about a basis trading and trying to profit from the mispricing activities. So, with respect to this sovereign credit default swaps, when I talk about hedging, they protect against the sovereign default. So, any credit event that could result in a country or a sovereign default occurring, there is a protection. That is where I talk about the hedging part. Whereas when we are talking about speculation part, there we are talking about naked positions, positive or negative movements, positive or negative perceptions about the underlying sovereign credit movement, and based on that taking the positions to primarily make profits. And the speculation positions, especially these naked positions, there was a ban also that was put up primarily to reduce. One of a couple of objectives coming up is primarily to reduce the liquidity, because you will have lesser number of positions, so liquidity will actually come down with respect to the sovereign CDS market, so which could result in some kind of harmonizing the European Union short selling market as well as the CDS trading market, because there was a heavy liquidity on the CDS trading market, whereas in the European Union short selling market not such much of liquidity exists, so they want to reduce the liquidity associated in the sovereign CDS market. So there has been a ban that has put on the naked sovereign CDS protection mechanism. So this even had created some kind of participants who are not that much affected by the ban because of loss of liquidity and because of not too much of market that is available, and because now transparency is going down because of not too much of market liquidity being present, price discovery is getting hampered. Because of all these things, what you could see is the purchasers of the sovereign credit default swap, even though they are unaffected by the ban, they started withdrawing from the market also. So overall the liquidity of the market has actually gone down, and this has forced many participants to look out for the alternatives to the sovereign credit default swaps. I'll come back to this. What are the various alternatives that are associated with that credit default swap? But speculation wise, this kind of trades are also permissible using this using this sovereign credit default swaps. And even the arbitrage wise, I was talking about the basis trading that could be possible, because there are different price differences that are existing here, not between two different markets. That's the reason I am not using the word arbitrage. Here I am talking about the price differences between the sovereign credit default swap market and the underlying sovereign debt market. So whenever we talk about the pricing of the underlying secure price differences between the underlying security and its corresponding derivative instrument, we refer to that as a basis trade. So here also we are talking about a sovereign credit default swap versus a underlying sovereign debt. The price differences that are existing, party who wants to exploit those price differences is also a kind of a trading that is very much possible. Because see here, when I am talking about, let's say, when I look at let's say a basis to be positive, when I say the basis is positive, what can I talk about? The spread on the bond or spread on the CDS is much higher than the spread on the underlying bond. So there could be that could be a mechanism where the strategy could be to sell the bond, because spread on the bond is lesser. So there could be a strategy with respect to sell the bond and probably sell protection also. Whereas on the other side, if the basis is looking negative, mean the spread on CDS is much lesser than the spread on the bond. So the risk on the bond is much higher, whereas the protection, the spread on the CDS is much lesser. So I can go for buying the bond and at the same time buy the protection. I can buy the bond and at the same time buy the protection, which will narrow the overall basis. So these kind of strategies can very well come into picture, and that can result in some kind of profitability that can come with respect to the sovereign credit default swap market. Coming to the various players who are involved in the market, I see majorly it is dominated by the dealer banks because they have huge exposures to the sovereign credit risk. Whereas apart from the dealer banks, we also see some non-dealer banks, or we look at security firms which are trading in these kind of sovereign credit default swaps, and even hedge funds which have decent exposure to this sovereign credit. They are all the players with respect to the sovereign default swaps. But overall, all these participants perceive that this market is more and more speculative in nature, more and more volatile in nature, and transparency is much lesser in this entire process compared to the typical sovereign bond market. Compared to the underlying sovereign bond market, the volatility is much higher, the speculation is much higher, because again, the underlying factors for the changes in all these prices could directly go with the government debt, or probably how the growth is occurring, the GDP growth, and what are the foreign reserves that are typically present, and the market risk factors. So all these things are really influencing the prices of both these things. But though there are some kind of differences that are existing, it is very well found out that they are not statistically significant. And corresponding to this itself, a couple of things that we should understand in the same context, a couple of things that need to be very much understood is, one, if the bid-ask spreads are much higher, right? If the bid-ask spreads are much higher, obviously it's an indication of a higher risk, right? In any instrument, the higher, so the risk is going to be much higher, and obviously that is an indication of the liquidity levels going much lesser and liquidity risk increasing in the process. So that's one thing we need to understand. And looking at a few tests regarding this, a couple of tests have been looked at. I want to talk about two major tests in this article which have been mentioned. One is the Hasbro statistic, an interesting statistic which talks about how the information incorporation happens with respect to the sovereign credit default swap versus underlying sovereign bond. Which one incorporates the new information faster into the price compared to the other? So the measure wise, a statistic of zero point 0.5 is being looked at. So if it is less than 0.05 or zero point 0.5, it means that the bond incorporates the information much faster compared to the credit default swap. If it is greater than zero point 0.5, then it means that the sovereign credit default swap incorporates the information quite quickly, corresponding to its underlying bond. It's a good numerical measure which clearly talks about at what speed the new information is incorporated into the sovereign credit default swap price versus the government bonds price. So greater than zero point 0.5 means sovereign credit default swap incorporates the information much faster into the price. Otherwise, it incorporates much slower into the price. And see, even a lot of negative perceptions that come about the market, they are not that heavily incorporated. That's one thing which could very easily be understood. And one more important test in the same regard is the Granger causality test. What this test clearly talks about is, it is more talking about the effects or impact because of overshooting of the spreads. As I said earlier, if the spreads are going to widen, the risk is going to increase. So it is talking more about impact of overshooting of the spread. So if the spread is increasing, obviously the funding costs, because the risk is going to increase, so obviously the funding costs are going to increase. So it will typically influence the bond markets. Underlying the bond markets are getting influenced quite heavily. So the one important test which we have to look at is, if the spread of the sovereign credit default swap is increasing, to what extent the funding costs go up, to what extent the underlying bond markets get increased, which in a way is resulting in more and more of positive correlation that is getting developed in the process. Whereas when I am looking at the Hansbrock statistics, it is more talking about how quickly the new information is being incorporated into the price, which market incorporates the information much faster into the price compared to the other one. Because if it is less than zero point 0.5, it's more of a lead lag kind of information relationship. Less than zero point 0.5, probably the sovereign credit default swap market lags the sovereign bond market. Greater than zero point 0.5, sovereign credit default swap market leads the underlying sovereign bond market in terms of information incorporation. Now, if there is a ban that has been put up on the sovereign credit default swap market, obviously the participants will try looking out for more and more alternate measures which are kind of proxies to this sovereign credit default swap market. So that is where some proxies that have come up in the process is CDS of Instead of government, look at almost closer to government with respect to the risk, which is the large financial institutions. Look out for the CDS of large financial institutions, or probably get into the government CDS of government bond futures, which are almost having similar levels of risk as that of the sovereign credit default swaps itself. But probably it is very clearly understood that they are more and more expensive compared to sovereign credit default swaps. The cost is much higher. The hedging is not provided that appropriately what has been provided by a sovereign credit default swap. So probably even the availability is an issue, especially in various emerging markets. So some issues do exist with respect to this. On the other side, there has been a kind of an alternative, which is with respect to a temporary ban. Even this would result in market liquidity getting reduced, just like a permanent ban itself. So the impacts are more or less the same. On the other side, there is a kind of a mechanism that can be handled through central clearing parties. Instead of putting a ban, there could be a central clearing party which can provide more and more transparency into the process. It can reduce the overall credit risk that is involved in the process. Some kind of multilateral netting can be very much possible using this centralized counterparty clearance kind of mechanisms. Margins can very well be introduced, but what has been observed is most of the CCPs, they did not show any kind of interest for clearing the sovereign credit default swaps centrally, because they have a perception, or there is a lot of wrong way risk that is very much present in the process. So they did not want to engage themselves into this wrong way risk, so which could very much be resolved by putting in bilateral margin positions, which is one way this entire risk can be reduced in the entire process. So, what is typically looked at understanding in this entire process is why is the ban that has come up, and what are the various alternatives that are available to bypass to make sure that the participation in this almost similar sovereign credit default swap market is happening, and these are the various procedures that are concerning the same. Any further queries regarding the same, you can very well get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.